Imagine this for a second. What if you could make more money while you're fast asleep than most people earn in an entire month at their day job?
Yeah, it's a pretty crazy thought.
Right. Welcome to today's deep dive. We've got a really fascinating stack of notes today, breaking down Robert Kiyosaki's classic Rich Dad, Poor Dad.
A total classic.
And our mission here is to uncover exactly how the wealthy generate passive income and break free from the traditional paycheck.
Which really is a complete paradigm shift. I mean,
Right.
to understand the solution, we first have to look at the core problem.
Trading time for money.
Exactly. We are so conditioned to view income solely as a trade. You know, we trade our time for a paycheck.
Mm-hmm.
But mathematically,
It has a fatal flaw.
it does.
Because even if you manage to negotiate a fantastic hourly rate, you still hit a hard ceiling.
Right?
The very moment you want to take a vacation or, heaven forbid, you get sick and stop working, the money just stops flowing completely.
It stops entirely.
Okay, so let's unpack this. If we aren't supposed to be the engine driving every single dollar, what exactly are the wealthy buying to do the work for them? The notes mention 3 specific vehicles.
Yeah. The first major vehicle is real estate. So instead of working for a monthly wage, you acquire a property, rent it out, and collect that income without needing to physically clock in every day.
And a lot of people assume you need massive generational wealth to even participate in that.
Oh, all the time.
Yeah.
But the sources emphasize that this is a mindset shift first. Even starting incredibly small with just a single rental unit completely changes the game. You've created an income source detached from your daily labor.
That makes total sense. But here's where it gets really interesting for me, because the second vehicle mentioned is paper assets. Can you break that down? Because to the average person, the stock market just sounds like a casino.
It's a fair point. In this context, paper assets primarily mean dividend-paying stocks. You are literally buying microscopic pieces of massive companies. Think Apple or Coca-Cola. And because you are a part owner, they send you a thank you check every single quarter, sharing their profits with you, simply for holding the stock.
0 daily effort required.
0.
And the notes talk about compound growth here too. I assume that just means taking those thank you checks and using them to buy even more pieces of the company.
That is the secret sauce right there. Compound growth is like a snowball rolling down a hill. Your money makes money, and then that new money makes even more money. It accelerates over time.
Wow. Which brings us to the third vehicle, business systems.
Yes.
Now I have to push back on this one. Owning a business sounds like the exact opposite of passive income. Most founders I know are grinding 80 hours a week and look permanently exhausted. That just sounds like buying yourself a much more stressful job.
Well, we connect these to the bigger picture. You're describing self-employment, not a business system.
Right.
The crucial distinction in this framework is that the system itself is the asset. You were talking about owning a franchise or an automated online storefront or an agency where the processes and other people are doing the heavy lifting.
I see.
You manage the system, you don't turn the wrenches.
Mm-hmm.
But this raises an important question. If the blueprint is this straightforward, just buy things that pay you, why doesn't everyone do it?
I was literally just thinking that. It sounds amazing on paper, but looking at these notes, it seems like we are practically wired to fail from the start.
We really are. There are 3 massive roadblocks. The first is simply a lack of financial education.
Right. Schools are basically designed to teach us how to be excellent, punctual employees.
Exactly. They don't teach us how to be asset owners.
And the second roadblock seems to be the fear of risk. People are terrified of stock markets dropping or ending up with a bad tenant who trashes a rental property.
Oh, yeah.
It seems like that fear actively pushes people right back toward the false safety of a biweekly paycheck.
It's comfortable, even if it's limiting. And that leads directly to the third and maybe most dangerous trap, which is lifestyle inflation.
Oh, this is a classic story. You finally get that big promotion at work and immediately celebrate by leasing a much shinier new car or moving into a bigger apartment.
Which brings up a fundamental concept from the book,
Mm-hmm.
the difference between an asset and a liability. The rule is incredibly simple but heavily misunderstood. Assets put money in your pocket. Liabilities take money out.
Like that shiny new car.
Right. It's losing value the second you drive it off the lot, and it requires insurance and maintenance. That is a liability. When you upgrade your lifestyle every time you get a raise, the money vanishes,
Yeah.
leaving nothing left over to actually invest in the assets we just talked about.
So what does this all mean for you listening right now? How do you actually break this endless cycle?
It requires compound growth time and absolute consistency, but it starts with one simple action.
Just one.
Just one.
The very next time you find yourself with a bit of extra money, a bonus, a tax refund, or just savings from skipping takeout, make the deliberate, conscious decision to buy an asset instead of a liability.
Buy a dividend stock.
Yes, save it for a down payment. Start building your system.
I love that. To wrap up this deep dive, we want to leave you with a lingering question to mull over today. If true financial freedom is about owning systems that buy back your time, how many days could your current assets sustain your lifestyle if you completely stopped working today?